This is the Perfect RIA, in case you didn't know. Bringing you all the strategies to help your business grow. Are you happy? Are you satisfied? Are you hanging on the edge of your seat? Sit back and listen in while you feel the beat, yeah!
I'm pretty sure my practice is worth $1 billion. Why? Because it is.
Welcome back to another amazing episode of the Perfect RIA podcast. I'm your host, Micah Shalansky, and with me, as usual, the legendary Matthew Jarvis. What's going on, bud?
Oh, Micah, I'm doing good. I'm inside a house. I can tell that you are by the beach, which is phenomenal. It makes me laugh. I saw a stand-up comedian. This was years ago when podcasting was new, and he was talking about riding the trolley through town, or the light rail. And he said, the light rail, I don't know about what you guys think about this thing, but it's full of homeless people. But I don't want you to worry because they were all podcasters, so not a big deal.
That's pretty much it. I am a stone's throw by my arm, which is pretty close, from the beach. So that is nice. We tried our best to kind of minimize the white noise in the background, so hopefully it's not going to be too bad for this episode. But it does make it kind of nice, right? To be up here a little bit before sunrise. I get up early anyways and have the beach kind of crashing down on it and kind of jamming out in some content. Makes it a lot of fun.
I love it. Well, today we want to chat about practice valuations. Now, as a listener, you might be thinking, I'm not interested in selling my practice, or I'm not interested in buying a practice. But practice valuation is something that we all need to be aware of for several reasons. One could simply be the value of your estate for doing tax planning. One could be contingency planning. How much life insurance do you need to have in place? Another could be if you do decide to sell your practice at some point. But ultimately, I think, Micah, it boils down to we need to be intentional about what we're focused on and make sure whatever milestone or benchmark we're aiming for is a real one and not something that somebody in an office somewhere made up.
You know, even if it's just to address the myth, Jarvis, that my practice is worth $1 billion because I love it, right? But what is the real value that you have? And then what decisions are you making? What adds enterprise value and what takes away from enterprise value? And it may not be what you think it is. And the best way we've often found to figure this out is by real deals, not theoretical, right? I've been told theoretical numbers about how much my practice is worth or not worth, all of these other things across the board, but to actually find out what are practices being bought and sold for, and to start walking down that path, you learn a lot. Another huge benefit about looking at your practice from the aspect of saying, hey, if I was to sell it, what would you do? It's going to force you to clean some things up. We all have some dirt that we swept underneath the carpet we're hoping nobody finds out about and that later we're going to fix. Not compliance issues or things like that, just things we haven't got around to fixing yet that if we went to sell, we would have to start addressing and fix. And sometimes those are just really good things to address just for your own efficiencies.
Well, Micah, I love what you said about looking at actual deals, right? I mean, that's really the core tenet of the Perfect RIA is do what works. And one of the first things we always do in our masterminds that we've talked quite a bit about is this financial undressing, where we say, great, pull up your QuickBooks, pull up your net worth statement, and let's really go through this line by line and look and say, both from an education standpoint as a listener, but also as the person in the hot seat. If you're the person in the hot seat, and somebody says, hey, I saw you spent $60,000 on marketing. What was that? Like, did it work? Was that just money you threw away? And it's a lot harder to tell yourself stories about that. But also, Micah, then I can look at these other practices and I can say, oh, that's interesting. You're paying this much for software. What software is that? And how is it working? And are you glad you have that contract?
Yeah, those are really good things to compare. And one of the things you're going to have to start doing is trying to get some streamlined, if you're doing a mastermind, some streamlined method of accounting. Because one of the things, everyone records things slightly different. So it's great to have kind of a summary sheet of saying, hey, what are the base numbers? Everyone report these the same. And then what are your QuickBooks? What are your actual P&Ls, et cetera, that you can dive into a little bit more. And it really does is an eye-opening experience. And it's fun to be able to look at that from the buyer standpoint, right? If you were to sell your practice and you're looking at this from an independent perspective, I know it's hard because it's your own books, but independent perspective, what would it have to do? I know a business came across our desk recently that someone is looking to sell and they wanted us to buy it, and we're kind of taking a peek at it. And as we're looking at it, one of the questions I would say is, hey, does this pay for itself? And someone else was like, oh, you got to look at all these other things. And I'm like, okay, I'm sure those things are important to look at. But one of the first things I want to look at is, does the business pay for itself? Where's the value that I'm getting from this business? And if I can't find it on the P&L, is there really any value there?
Yeah, and a lot of times this is where people get sucked into it. Michael, you and I have talked about timeshare presentations or how vacation rentals always make money. We get sucked into kind of the allure of it. Like, oh, if I have 2 practices, the economies of scale will be so incredible that I'll not have to work at all and it will just be a money machine. And when we speak that out loud, it sounds absurd, but so often that's what advisors are thinking. I'll just take this extra revenue on, no expenses, no hassle, no client meetings, no administrative, no team members. I'll just take this revenue on. It'll be bolt-on revenue, not a big deal.
And the other thing that we're looking at, Jarvis, is not just the finances side of it, but the time side of it as well, right? I'm looking at buying this other practice, and it's not in Alaska. Good news, it's quasi on the West Coast. And so, but I'm going to have to fly down there. What's that service model going to look like? How am I going to meet with their clients? They have no idea who I am. How am I going to integrate their team? Their team has no idea who I am, right? How are we going to integrate all of these different things? And the illusion that I would just cut their staff and then just have mine and run everything, that's totally the wrong way to look at it, in my opinion. Now, I also haven't done these deals, so I could be completely wrong, but I would look at it saying, no, I got to keep all of their team. I got to keep all of their systems. I got to keep everything in place, at least for the first 12 months, and really make sure that I got a well-oiled machine and I figure it out. And I probably got to double whatever time I think it's going to take on my calendar. I probably have to double that time and actually book the time to be there to run that. That's my initial thinking on this.
Well, another piece on time is that when we see these practice valuations, which I think are 100% made up, every time I see a multiple cited, I think it's 100% made up because it's never backed by this deal. Oh, there's these buyers paying 3x, 6x, 20x, a million X. Cool. What deal was it? Who was the buyer? Who was the seller? But even in all these made up numbers, it never accounts for time. Mike, you and I have done some evaluations of tax practices to purchase, and that's something you really have to drill into. What are your billable hours? Now, with accountants, we can look at this because they have billable hours. But if we look and say, hey, you're consistently working 80 hours a week, which is not out of the ordinary at all for accountants, that's not the same as a practice where it's 40 hours a week, or Mike, a practice like yours and I's where it's closer to 10 to 15 hours in non-surge weeks. Those are dramatically different practices. And again, that's missing from all of the industry discussions. But again, when we're also comparing, if we're trying to find a practice to benchmark my own practice on, it's got to be somebody who's putting in similar work hours.
Yeah, and then the methodology with clients, I would think, is another big thing that we're looking at. Now, again, this is speaking from a little bit of theory, so I do apologize on this, right? We like to speak about what works. Haven't done this successfully, so these are just things that we're looking at right now as we're evaluating this other practice and should we buy it or not. If you have better ideas because you've actually done this, I would love that feedback to come in. Another thing, Jarvis, that comes up on this is they say, oh, well, here's an industry study, right? When I go out and ask some peers and I ask some other people, they're like, oh, well, here's this industry study. And I'm like, great, more made up numbers, right? None of these numbers are verified. None of these numbers are real. And is it really just a selection biased on who fills these out? Because I find less and less advisors that are hyper successful are taking the time to fill out these surveys because I'm not making any decisions based on that survey data because I don't know what's real and not real. Why am I going to waste hours of my time to fill it out?
Yeah, and I think the only person that has verifiable data, the custodians, right? The custodians have all the billing files, but they've yet to publish any of that. So at least we could do a comparison on top line. I mean, they know how many reps there are assigned to it. They know average revenue per client, households. But I've not ever seen any of the custodians release that. The custodians have released surveys, like Fidelity and Schwab will release their studies, but they've never used their own data that I know of. It's always advisor self-reported data. And I know that because when I go in to do the Fidelity survey, it asks me to fill all that information again. Mike, I know the same for the Schwab survey. Like, wait a second, why are you asking me all my fee billing and revenue numbers? You have that. Oh, wait, you're not using that. So these are all made up. It's like me trying to tell you how big that fish was I caught. Geez, I'm pretty sure the thing was a monster.
Yeah, that I was really disappointed in Schwab. I know it's all custodians, but I'll just speak to Schwab because that's where I'm at, is when I went to fill out the survey and they ported none of my data into it. Now, if it was my first year with them, sure, I could totally see that, right? But year 2, year 3, why don't you port that data in for the survey? Why don't you get real number and make it non-editable numbers? Assets at Schwab, boom. Now, if you have another custodian, okay, maybe you have to hardline enter that information in.
Sure.
But at least be able to show this is verified data and unverified data. Why don't we have that in the system? Why don't you take the time, Schwab, to put Fidelity, et cetera, to put that in place and say, no, these are the real numbers that are there. And it's just like a client on a tax return, right? I don't blame advisors, because if you ask me how much my AUM is, by the moment it changes, right? And so, oh, maybe it's this, maybe it's this. It's some range that's going to be there, but I don't know the exact number. I'm pretty close in how many households I have, but unless I go run a report for the entire firm, I don't know the exact households. I'm pretty close in how much revenue we make, but unless I go and run QuickBooks, I don't know the exact number of the revenue. So I get it when advisors are talking, there's always an ish number, but we need to get back to verified data, just like on a tax return, right? And a client's tax return, a client says, oh, I make X amount of money. Fantastic. There's $5,000 a month deposited per paycheck into my account. Okay, great. Well, is that per month or per paycheck? Because you just said two different things, right? How much a month are you getting? I want that LES. I want that leave earning statement, their pay statement. I want their tax return to come in, right? And it's not that I don't believe the client, but we get in this autopilot aspect of it where we don't really know the numbers, and I want the documentation to prove it. We need that same thing. Maybe it's just what I want. Maybe we don't need it as an industry, but I would like it to make this deal feel better for me.
Yeah, and Micah, maybe you and I are overly jaded or overly cynical, but we've talked about this, and I mentioned a minute ago, as it relates to buying vacation rentals or really anything that comes from a realtor, right? That's probably like the worst example of like, hey, if you buy this vacation rental, it will pay for itself. Cool, great news. Could we just see a copy of the tax return, right? This is something I got from you, Micah, and I've used successfully with a lot of clients. Great news. I'm sure their numbers are right. Let's just get a copy of the tax return. Nobody ever lies or overstates their income to the IRS. And then I've seen so many deals just ghost. As soon as we ask for the tax return, the deal ghosts because the numbers were all made up. And again, I run into advisors, same thing. Oh, so-and-so sold his practice for 17X. Cool. Who was it? Who bought it? And did you see the deal terms? Or was this a drinking story that you heard? And so that's, again, I want to see the real numbers, especially if you're thinking about buying or selling a practice. Like, I need to see real deals, and I need to make sure the person giving me the information has an incentive. So Micah, you and I talked to several of the leading practice valuation people in the industry, won't name names, and they gave us these great stories, but the only person who really gave us a straight shot was when we talked to Live Oak Bank, and we said, hey, what are you actually lending on? Because they're the ones that are there after the deal, right? The consultants take their check and they're gone. Live Oak's got to make sure this deal goes all the way to fruition, and the story they told us was dramatically different.
Yes. And
there was also no sales pitch. They're just like, listen, here's how we evaluate these deals. Yes, you have to get the valuation. Here's what we'll lend on, and that's it. End of story.
In a brilliant way for them to take it, right? Because they're not saying the practice isn't worth that, because now we get into an emotional topic. It's perfect. Here's what we're going to lend on. This is the formula for lending. Go from there. Now, I'm using that as an evaluation tool personally. I'm taking that formula, I'm plugging it right in and saying, does the practice pay for itself? Well, based on the lending terms from Live Oak, will this practice generate enough revenue to pay for itself, yes or no? And if the answer is no, I got to ask a hard question, why am I buying it? Now, a buddy sent us a deal that's going through from somebody to somebody of somebody, right? But when I start looking through this potential deal, the average fee is about 0.6, 0.7% that's going through. And so he's looking at buying it for, I don't know, 2.5, 3x gross. Let's call it 3x gross to make it simplistic. Let's say it's a million, what was it? No, I'm sorry, it was 3x net. So it's 800,000 in revenue for discussion times 3x. So, they're about 2.4 million-ish is kind of what they're going to pay for this practice. But you start looking at it, and I put in the Live Oak numbers, and I say, ooh, I don't know if there's enough cash flow to pay for this. But then I look at the average billing rate. The average billing rate is 60 bips. Okay, well, that's a whole point less than my average billing rate. So now there's a potential upside to this practice. If I buy it, what's the upgrade opportunity with these clients? Could I get the average fee north of 0.6%? If I can now make that a point and a quarter, 1.75, something of that nature, now this practice is going to be profitable. So I could see potentially in that case taking a shot at it and saying, well, I'm going to pay this. It's going to break even at best and paying for itself. Maybe I'm paying a little bit more than Live Oak says, so to speak, based on the formula. But now there's upside in this practice because I can upsell these clients. I can graduate to more financial planning. I can provide more value, more services, etc. So there's that aspect of it that I like.
Yeah, it's certainly a piece. And this is a bit of a side tangent. It does emphasize, again, the importance of always looking at real numbers. What came to mind, I'm not sure why, what came to mind is clients who are expecting an inheritance or clients who are expecting a big windfall of some sort. Hey, we're going to sell this piece of property. We're going to sell this business. We're going to get this inheritance. I want to plan based on this. And the number that they've come up with is quite a large number. And so I want to start taking distributions based on that. And my approach, Mike, always curious yours, is when we get that money, then we'll build it in. So we'll account for it in our estate planning and our risk management. I'm not going to cash flow on any number that's not a real hard cash number. So when you tell me, hey, this piece of land that we've got in the middle of the desert, we're going to sell it for $5 million. Cool. When you get the $5 million, then we'll account for it. When you inherit the $5 million from your long lost aunt, then we'll account for it. Until then, it's just sort of a gee whiz. And the same with all these practice numbers. It's a gee whiz unless I'm looking at a tax return.
On the client side, the only thing I like to add to that, Jarvis, I'm the same page, right? We account for it when it comes in. I like to start giving them a formula, though, of things they need to think about. Hey, remember, we got to give 30% to the IRS. So anything you sell it for, yeah, we'll figure out the exact tax bill, but at least carve out 30% has to go to IRS, and we need to do A, B, and C. So I start carving out money right away. Otherwise, what I've experienced, and I'm sure you have the same thing, is when the client gets that payday, they're thinking 100% of it is their money, and they want to go blow it, they want to go spend it. They've already mentally spent that money, and now you're Debbie Downer here saying, oh, we forgot about all these other things. So I love giving them a little bit of a formula to say, hey, let's be really careful because a big chunk of that has to go to the IRS.
Yeah. Yeah, that's a great one. Well, Micah, how about for advisors who are listening and say, well, I have no interest in selling my practice. It's really not on my table right now. How do we pivot that to our day-to-day? And I think really a lot of this boils down to what are you actually measuring in your practice?
Yes.
Micah, you mentioned the idea of if you ask me what my AUM is, it's kind of like whatever I remember. Of course, obviously what's on my ADV is the actual stated number from the custodian. But I do the same thing with days off. You say, how many days off have you taken this year? Well, yeah, it's probably, I don't know, maybe it's 37 days. But if I don't have my physical calendar and I'm counting down the days, and the reason that's so important is whatever you measure improves. Same with that advisor you said it's 60 bips. We've run into this all the time, right? Advisor will say, hey, I'm charging 1% or 1.5% or whatever. We do the numbers and their average fee is 70 bips. Okay, well, where's the disconnect here? And advisors a lot of times will fervently argue with us. No, my fee is 1.25. Yeah, but I'm just doing your AUM divided into your revenue, and it's 0.6. And they'll argue back and forth. We're just like, well, where's the numbers? But it's so easy, and I don't mean this with disrespect. It's so easy to get sucked into the story that you've told yourself. And every time you tell that story, it rounds up just a little bit until the story you're telling is now so far removed from the reality that you're drinking your own Kool-Aid, as we've talked about several times before.
Yeah, that can be really, really devastating in the long run, right? You're lying to yourself, you're lying to your team, you're lying to your spouse, right? And it's not an intentional lie, but it's still a lie. You are not telling the truth. And if you're not telling the truth, what camp does that go into, right? So this is going to go back to be intentional. Now, there could be a reason, I'm just going to take this as, let's say it's a Wirehouse practice, that's 0.6%. And if you buy that, you can upgrade things, you can improve client relationships, you can do things in order to add more value with our value sledgehammer, by the way. We're going to add more value in order to generate more revenue. Well, that's fantastic. So that would I would be willing to pay a little bit more for a Wirehouse practice than I would a practice that's already valuation-wise, right? Not dollar-wise, but multiple-wise. But a practice that's already streamlined, I don't know if I would pay as much as high as a multiple for that because I don't see my upgrade opportunity. Now, does this mean you shouldn't maximize your practice and optimize it for lifestyle? No, right? I love the concept that you should build to sell, but you should operate it to live, right? I'm not planning on selling my practice the next 10 years. Who knows what the next 10 years is going to bring? I love financial planning. I love what I do. I want to be very keen that I'm building it to sell. I'm putting all of the pieces in place that God forbid if something happens to Micah, somebody else can help step in and run Shalansky and Associates. It's a very key piece in our succession plan. However, I'm building it to operate for our lifestyle. So some things I'm being very intentional in choosing on to make sure that we're getting these things in the long run.
Another thing, Micah, that comes up on practice valuation, I ran into this on a couple of different advisors. So I talked to you and I both talked to a lot of multi-generational advisors because we work in multi-generational practices. And I've talked to a couple different ones where and it's whether it's family or it's unrelated parties, where the elder of the two advisors, the one that owns the practice, has this valuation in mind. And it's really, at the end of the day, it's the number they need to retire because they've been counting on this. This has been their golden goose or whatever analogy you want to use. And so they're saying, hey, I need X gazillion dollars for this thing. And the numbers don't support it at all. And because they become fixated on it and they've saved no other money, this is something we've ranted on several occasions. They haven't been following their own advice. They're desperate for the sale, which is part of the reason a lot of these practices never transition, is they have not saved any money. They've been living on the cash flow, and they realize that they can never get enough equity out of this thing to replace their lifestyle. And so I mention this as a word of warning to anybody who's coming into a practice expecting it to transition. Unless you have that in ironclad and they have enough money to be financially secure, independent of the practice, run away. That deal is just never going to work. You're going to be talking to me 10 years from now, still waiting for this guy to die in his chair, which is the only way you're going to get this practice.
That is such a key thing, because these people don't even realize they haven't saved enough, right? They're like, no, I've put all my money and time and I've invested into my business and whatnot, so it's worth $1 gazillion because of it, but it's still a math question at the end of the day. And if you're working in one of those practices and you're the one that's supposed to buy it out, there's a lot you can learn, there's a lot of value you can add, but you might want to take a quick little peek at it and say, hey, at the end of the day, does this math work? And if the owner is, you are my retirement plan, that's a warning sign.
Now, we're kind of bouncing all over this, but a flip side of this is, and whenever time we talk about valuation, somebody will text us or message us. They'll say, no, I've seen valuations of 6x, 8x, 12x, whatever the case may be. Couple of warnings always come to mind there. One, if somebody's offering you dramatically more than whatever these averages are, what's going on behind the scenes? A lot of times when you hear these bigger numbers, it's because the roll-ups are buying talent, right? So you are now an indentured servant of this organization, and so they offered you 6x, but it's super contingent. In fact, some friends of ours that do M&A work, they said, tell me the price you want, and I'll tell you the deal terms. They said, we can get you any price you want, but the terms are going to be terrible. And that's where we see these like forgivable loans, and we start peeling it back, and it's like, hey, listen, we'll pay you $6 million, but the first year the practice doesn't grow at 40%, you lose half of that number. And so, again, we have to watch and say, hey, if the numbers seem higher, if you're thinking, oh, Matt, I got this offer for way higher than you guys are talking about, well, one, send me the deal terms because I'd love to take a look at it. But two, look at what exactly it is they're buying. Is it their book that you're buying, or are they buying talent, in which case they're putting you in as an indentured servant?
Which, not want to rag on that, right? If that's the deal that you want, rock on. And if you think that, say, hey, this is a great plan, I can exit, I'm going to get a little bit of cash now, I want to still doing this, I like the working conditions of their other offices, not your office, because you will get moved to theirs. Example is, what's the one that Goldman bought, Jarvis, that put the time clocks in the practice?
Why can't I think of it? United Capital.
Thank you. Yeah, United Capital, right? So United Capital, right? The advisors might have been, oh, this is fantastic. We love our work-life balance, et cetera. Everything's great. Goldman bought them and came and put time clocks in and says, congratulations, we want to see hours, butts in the seat, right? So make sure you're not looking at this with rose-colored glasses, that this is the way I always operate, therefore that's the way it's going to continue. No. What are the way their current offices operate? You're going to move into that model. They're not going to operate multiple other models.
This goes back again to tracking real numbers. I know another group, an advisor who sold to a bigger roll-up RIA, and in her mind, she'd always told me, I knew her for several years, hey, I'm working 40, 50, 60 hours a week. Turns out she was working more like 30 hours a week. And so when the group bought her, they're like, no, you're working 40 hours a week. You're punching the time clock similar to the Goldman deal. And she hated it because they're like, hey, listen, how much vacation do you take? Oh, I don't really take any vacation. Great, because you get 2 weeks. Turned out she was taking more like 6 to 8. How fast is your practice growing? Oh, we're bringing on $20 million in new assets a year. Perfect. If you bring in less than 20, you lose all your bonuses for the year. And so that's another place where if you're selling and not leaving, you need to be really honest with yourself. What are those numbers? And really detailed on those expectations of the seller. Not what they say is going to happen, but what's written into the contract. One of these like, oh, hey, don't worry about it, Micah. You can take all the time off you want. Except the contract says 2 weeks. So if it's all the time we can want, change the contract.
Yeah, all the time you want within 2 weeks. That's the deal, right?
Yeah.
So, and this is something.
Go ahead.
I was going to say, this is something that you need to have somebody else put the numbers together on. You are not unbiased enough to put these numbers together. So our financials, when we do our corporate retreats and whatnot, I don't put our financials together. None of the other owners put our financials together. We have our bookkeeper put all of our financials together, right? Because I don't want to be asking the question, hey, Pops, why did you put this number here? Why is this adjusted? Why is this massaged or whatever it is, right? Because we're all biased in some way. I want an independent party presenting this number. So if I was doing the deal, and it says, Micah, how much vacation time do you put off? Yes, I think I have a number. I'd want someone else to go look at my calendar and say, hey, I got my number written down. You go figure out based on my calendar what you think the number is, and let's compare notes before I go back to that. Same thing with bringing on assets. Same thing with bringing on clients, right? Who's a third party that could look at this? And maybe it's an employee, but it's just not you.
The other place this really comes to mind, Micah, as far as on the theme of are we lying to ourselves or we're drinking the Kool-Aid, is payouts. So I'll run into advisors all the time. They'll say, no, my broker deal, they pay out 97%. Yeah, you get 97% of whatever they say you get. And so you have to have an independent look. They'll say, oh, no. There's one mega RA group. We talked to an advisor who wanted to join our mastermind. We said, hey, how much is this group charging? He says, they're charging me nothing. Immediate red flag. Zero. And we said, well, that obviously can't be the case. They can't run for free. He says, I don't really know how they run. They're making it up, on the spread or whatever. It sounds like Bernie Madoff to me. And so we boiled down, right? Wasn't that Bernie Madoff's thing? Like, don't worry how I'm getting paid. The roll-up was charging the clients $150, and they were paying the advisor 100% of one. And so he's believing this story of I'm getting 100% payout. Really, I'm getting 102% payout. I don't know how they do it. No, you're getting like a 60% payout. And so this is again where you can't. It's just the theme of never believe any numbers that someone tells you or any numbers you tell yourself. They have to be verified numbers. So in the example of the payout grid, what's the gross tippy top line all in cost that the client's paying? The wrap fee, the load fee, the transaction fees, all these things. What's the very top line number that the client's paying? And then what are you taking? That's where we look at our gross net spread, not what the grid is. And you get 97% of the grid. Nope. What's the tippy top number before everything else?
We still get that question from advisors. Hey, when you say tippy top, does it include? Yes. What about? Yes. 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 The tippy top, right? Everything the client pays is the tippy top. And why do Jarvis and I pick on this number? Because it's consistent, right? Everyone has a different grid. Everyone has a different counting system with what's inside the grid, what's outside the grid, what are additional fees, what the client has to pay versus what you have to pay exactly. But the only thing that's very similar in every single one of our practices pretty much across the board is what's taken out of the client account. That gross number is a measurable number that's consistent. The most consistent number we have. Fantastic. We take that. Then we go to what shows up on your tax return. Again, people don't over-report their income to the IRS, right? So we take that tax return number and then we say, great, this is how we're gonna calculate your math on what your payout is and what your net is, etc. Because this, again, is some third-party verifiable numbers and we don't put our bias into it.
You and I, Micah, looked at a deal sheet because we're always looking at deals and always trying to piece the numbers together. And it was a very substantial deal. We won't go into details because it's confidential. But as we were looking through these deal terms with a roll-up RIA that does not need to be named, we started adding up. And at first, it seemed like, it's 3 bips to be on this platform. Well, wait a second. Down here on page 13, there's another 5 bips. On page 23, there's another 8 bips. When we get down to the end of the game and it's 23 bips or 42 bips, actually, you and I couldn't even figure it out for sure. We had to pay somebody to build a spreadsheet to try to map out all this math. I like to think that we're pretty smart guys, but this was such a convoluted deal structure, and it included all these assumptions on how fast your practice was going to grow and all these different things that again, even on a really big deal, it was not clear at all what the final bill was going to be. And again, it just goes back to me of you got to have your own data, and it has to be real data, not something you heard or remembered.
Yeah, amen to that. All right, Jarvis, this podcast is all about action items, things that we can take and implement right now this week. So I'm going to kick it off and say the first thing you need to do, you need to build to sell, but operate to live. You need to be hyper intentional about these numbers. I love that concept of being built to sell, but operate it to live for your lifestyle, what you're solving for.
Yeah, actually, number 2, we've got to remember that we always tell ourselves stories, and atrophy is a natural state of the world. And so you've always got to be aiming for something. We've talked in the past about personal development, professional development, and we've talked about finding a practice that you want to mirror, that you want to achieve. But whatever your intentional target is, you've got to be measuring the numbers to get there, or you won't ever get there. You'll sort of kid yourself and you'll say, yeah, I'm in the best shape of my life, and you're 30 pounds overweight, right? Whatever it is, you've got to have real numbers and really be intentional. What is it you're trying to achieve? Maybe not forever, maybe not till the end of time, but at least for this year or the next couple of years, and then just religiously monitor those numbers.
I love it. And also on those numbers, who is putting those numbers together? Who's creating them? Who's gathering, etc. You need to get a system in place. And by the way, I do this sort of business planning. When I'm getting ready for business planning, I have a list of data that I need, and I kick it out to my team to generate that data. I don't go look that data up. After they get it to me, I'm going to review that data and say, hey, where do these numbers come from? And I'm going to start picking it apart, etc. But I won't pick apart my numbers as much as I'll pick apart somebody else's. So who is getting you this information? You need to have somebody, whether it's your bookkeeper, your CPA, a team member, etc., that can generate these numbers and report them to you. You evaluate them to make sure they're correct.
That's right. Last and final action item for today, on March, which is only just a few weeks away, we are doing our Nation webinar that's available to all of our podcast listeners, including yours truly, whoever's listening here. And we're going to talk about the one big mistake that's keeping your practice from doubling its value, both the enterprise value, but also its value to clients. So that's March, the one big mistake. And it's going to be a lot of fun. Micah, you and I have been preparing for months for this. So I hope to see you all there.
Awesome. Well, Jarvis, until next time, happy planning.
Happy planning.
Information designed to change lives. Financial planning can make you thrive. Start today, don't think twice.